Albert Einstein allegedly called compound interest the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. But here's what Einstein didn't tell you. You can harness this wonder without being a mathematician, without watching the stock market, and without spending more than 10 minutes a year on your investments. This is the lazy person's guide to compound interest. And it works better than 90% of the active strategies that rich people pay thousands of dollars for. If you stay until the end of this video, you'll learn exactly how to build a completely automated set-it-and-forget-it portfolio that harnesses the full power of compound interest. You'll never need to pick a stock, time the market, or stress about a crash again. Just set up a few automatic transfers, choose a single fund, and let time do the heavy lifting. This is the closest thing to a free lunch in finance. My name is your name, and today we're making compound interest boring in the best possible way. Let me start with a story that will make you want to start today. Meet two friends, Amy and Beth. Amy starts investing at age 25. She puts $5,000 a year into a simple index fund for just 10 years from age 25 to 35. Then she stops completely. She never adds another penny. Beth starts at age 35. She invests $5,000 a year, the same amount, but she keeps going for 30 years, all the way to age 65. Who has more money at retirement? Most people guess Beth because she invested for 30 years while Amy only invested for 10. But they're wrong. At a 9% average annual return, Amy, who invested only $50,000 total, ends up with over $950,000 at age 65. Beth, who invested a $150,000 total, ends up with just over $800,000. Amy wins by $150,000 despite investing $100,000 less. That's compound interest. That's starting early. That's the magic that lazy people can exploit. Time in the market beats timing the market, and starting early beats investing more later. Now, let me show you the simple math. Compound interest means you earn interest on your interest. If you invest $1,000 at 8% return, after 1 year you have $1,080. After 2 years you have $166. That's $80 interest on the original plus $640 interest on the first year's interest. After 10 years, that $1,000 becomes $2,159. After 20 years, $4,660. After 30 years, $10,063. That's a tenfold return without adding a single extra dollar. The longer you let it run, the faster it grows. The 20th year adds more than the first 10 years combined. The 30th year adds more than the first 20 combined. That's exponential growth, and you don't need to do anything after the initial investment. That's the lazy person's dream. But here's the problem most people face. They know compound interest works, but they don't know how to invest. They're afraid of picking the wrong stock. They're afraid of losing money. They end up doing nothing, or they put money in a savings account earning 0.5%, and they miss out on decades of compounding. The solution is the set it and forget it portfolio. It's a single investment that gives you instant diversification across thousands of stocks and bonds. You don't need to pick anything. You don't need to rebalance. You don't need to watch the news. You just buy it, hold it, and add money on a schedule. That's it. So what is this magical investment? It's called a target date retirement fund or a balanced index fund. Let me give you the specific tickers. For most people, the best option is a target date fund from Vanguard, Fidelity, or Schwab. Pick the year closest to when you plan to retire, say 2060 for a 30-year-old today. The fund automatically adjusts its mix of stocks and bonds as you get older. More stocks when you're young, more bonds when you're near retirement. You never have to lift a finger. The expense ratio is about 0.08% to 0.15%. That's $8 to $15 per year on a $10 Zuzant investment. Vanguard's target date funds are VTVX 2045, VFFVX 2050, VFX 2055, etc. Fidelity has similar series. Schwab does too. You can buy them in any brokerage account. If you don't want a target date fund, the second best option is a single balance fund like the Vanguard Balanced Index Fund, VBX, 60% stocks, 40% bonds, fixed allocation, or a total world stock fund like VT, 100% stocks, but more volatile. For true set it and forget it, the target date fund is superior because it de-risks automatically. You literally never have to think about it again. Just add money. Now, let me address the biggest objection. But target date funds are too conservative. I can get high returns picking my own stocks. Maybe, but you can also lose a lot more. And the time and stress you spend picking stocks is time you're not spending with your family, on your hobbies, or at your job earning more money. The set it and forget it portfolio is not designed to beat the market. It's designed to match the market with minimal effort. And matching the market over 30 years will make you a millionaire if you're consistent. That's good enough for most lazy people, including me. Let me give you a real example of a set it and forget it portfolio in action. A viewer named Tom, age 25, started investing $300 a month into the Vanguard Target Retirement 2065 Fund, VLXVX. He set up an automatic transfer from his checking account on the first of every month. He never looked at his balance, never read financial news, never changed anything. By age 35, he had over $60,000 without ever making a single active decision. By age 45, over $180,000. By age 55, over $500,000. He had over $1.3 million. He invested a total of $144,000 over 40 years. The rest was compound interest, and he spent 0 hours worrying about his portfolio. That's the lazy person's path to wealth. Now, let me break down the exact steps to set up your own set it and forget it portfolio. You can do all of this in under an hour, starting right now. Step 1. Open a brokerage account. Asterisk if you don't have one, go to Vanguard, Fidelity, or Schwab. Click Open an Account. Choose an individual brokerage account or an IRA. If you have earned income, open a Roth IRA. It's tax-free growth. This takes 15 minutes. Step 2. Choose your target date fund. Go to the fund screener. Search for target retirement plus the year closest to when you turn 65. If you're 30 now, you'll turn 65 in 2061. So choose 2060 or 2065. Vanguard's 2065 fund is VLXVX. Fidelity's is FDKVX. Schwab's is SWEX. Write down the ticker. Step 3. Fund the account. Asterisk transfer money from your bank account. Start with any amount, even $100. You don't need a large sum to begin. Asterisk. Step 4. Set up automatic investments. In your brokerage account, look for automatic investment or automatic transfer. Set it to pull money from your checking account every month. Say $200, $300, or whatever you can afford. Also set it to automatically buy the target date fund with that money. This is crucial. You want the entire process to be hands-off. Step 5. Turn on dividend reinvestment, DRIP. Asterisk. This automatically uses any dividends or capital gains distributions to buy more shares of the fund. Without it, dividends will sit in cash and you'll miss out on compounding. Most brokerages have a button called Reinvest Dividends in your account settings. Step 6. Delete the app. Seriously, do not check your portfolio more than once a year. The more you check, the more likely you are to panic sell during a crash. Set a calendar reminder for the 1st of January each year to check your balance, confirm your automatic contributions are working, and update your target date fund if needed. every 5-10 years. That's it. Step 7. Increase your contribution every time you get a raise. Asterisk. When your income goes up, increase your automatic transfer by half the raise amount. If you get a $2,000 raise, increase your monthly investment by $80, half of $2,000 + 12. This keeps your savings rate growing without feeling a pinch. That's the entire system. 7 steps, 1 hour, then nothing for a year. That's lazy investing, and it works. Now, let me address some common fears and questions. What if the market crashes? Will I lose everything? No. In a crash, the stock portion of your target date fund will drop. But bonds will cushion the fall, and you're buying more shares at lower prices with your automatic contributions. Crashes are good for long-term investors. The market has always recovered, and it always will. If you panic sell, you lock in losses. If you do nothing, you ride the recovery. The set it and forget it portfolio forces you to do nothing. That's the genius of it. What about fees? Aren't target date funds expensive? Vanguard's target date funds charge 0.08% expense ratio. That's $80 per year on a $100,000 portfolio. Fidelity's index target date funds charge even less, some at 0.05% for their Fidelity Freedom Index series. These are microscopic. The actively managed version of target date funds can be 0.5% to 1.0%. So make sure you choose the index version. Vanguards are all 2 lines: Freedom Fund, active, high fee, and Freedom Index Fund, passive, low fee. Choose the index version. What if I want to be more aggressive than a target date fund? You can use a total stock market fund like VTI or VT. That's 100% stocks, higher expected returns, higher volatility. If you can stomach a 50% drop without selling, go for it. But the set it and forget it philosophy works best with a balanced fund because you're less likely to panic. The best portfolio is the one you can stick with. For most lazy people, that's a target date fund. What if I want to be more conservative than a target date fund? Asterisk, you can choose an earlier target date. If you're 30 but want a 2030 fund, that will be mostly bonds. That's too conservative for most people. Stick with the date that matches your retirement age. Can I use a robo-advisor instead? Yes. Robo-advisors like Betterment, Wealthfront, and SoFi do the same thing as a target date fund: automatic investing, del rebalancing, tax loss harvesting. Their fees are around 0.25% plus fund fees. That's higher than a target date fund 0.08%. But they offer more features like tax loss harvesting and financial planning. For pure lazy investing, target date funds are cheaper and simpler. I recommend them over robo-advisors for most people. What about a 401(n)? My work offers target date funds. Perfect! Your 401(n) is the ultimate set it and forget it vehicle. You choose the target date fund, set your contribution percentage, and money comes out of every paycheck automatically. Your employer may even offer a match, free money. If your 401(n) has target date funds with low expense ratios, under 0.3 here, use them. If they only have expensive active funds, use a mix of low-cost stock and bond funds instead. But for most people, the 401(a) target date fund is the easiest path. Now, let me show you the power of starting early with a concrete comparison. We'll use 3 lazy investors: Lazy Larry, Procrastinator Paul, and Late Bloomer Laura. Lazy Larry starts at 25. He invests $200 a month into a target date fund earning 8%. He stops at 65. Total invested $96,000. Final balance over $700,000. Procrastinator Paul starts at 35. He invests $400 a month, twice as much, to try to catch up. He stops at 65. Total invested $144,000. Final balance about $600,000. He invested more money, ended up with less. Late Bloomer Laura starts at 45. She invests $800 a month, 4 times Larry's amount. Total invested $192,000. Final balance? About $240,000. She invested twice as much as Larry, but ended up with 1/3 as much. That's the cost of waiting. The best time to start was 10 years ago. The second best time is today. Do not delay. Let me tell you about the most inspiring lazy investor I know. His name is Bob. Bob was a janitor at a university. He had no finance education. He started investing in his 401(a) at age 30. He chose the target date fund. He never changed it. He never checked his balance. He just let the automatic contributions run. When Bob retired at 65, he had over $2 million. He was a janitor. The university's professors and administrators, who made 3 times his salary, often retired with less because they tried to time the market, pick stocks, and panicked in crashes. Bob did nothing. He won. Bob's story is not unique. The Fidelity Investments client data shows that the best performing accounts over